If you're new to investing, you've probably heard people say things like the S&P 500 is up today or the S&P 500 just hit a new high. But what exactly is the S&P 500? Is it a stock? Is it a company? And why does it get so much attention from investors around the world? In the next 5 minutes, we're going to break down the S&P 500 in simple terms and explain why it's one of the most important benchmarks when it comes to investing. The S&P 500 is an index that tracks approximately 500 of the largest publicly traded companies in the United States. The S&P stands for Standard & Poor's, the financial company that created and maintains the index. And here's an important point. The S&P 500 is not actually a list of exactly 500 stocks all the time. The number of companies can vary slightly because some companies have multiple share classes. The index is designed to represent a broad cross-section of large U.S. businesses. That includes companies from sectors like technology, healthcare, financials, consumer goods, energy, communications, and more. So instead of looking at hundreds of individual stocks, investors can look at the S&P 500 as a kind of snapshot of the large U.S. companies. Now here's where things get interesting. The S&P 500 is what you call a market cap weighted index. That sounds complicated, but the basic idea is actually simple. The larger a company is, the greater its influence on the index. For example, imagine you had an index containing just two companies. Company A is worth $900 billion. Company B is worth $100 billion. Company A would have roughly 9 times the influence of Company B on that index. The S&P 500 works in a similar way. This means the biggest companies can have a much larger impact on the index than smaller companies. So when you hear that the S&P 500 is moving, remember that you're not looking at 500 companies all moving equally. The performance of the largest companies can have significant effect on the overall index. So why does everyone care about this index? One reason is that the S&P 500 is widely used as a benchmark for the U.S. stock market. When financial news says the stock market had a good day or a bad day, the S&P 500 is often the one of the first numbers people look at. It can also help investors compare their own performance. For example, suppose your portfolio gained 7% over a year. That sounds pretty good. But if the S&P 500 gained 15% during that same period, your portfolio actually underperformed the benchmark. On the other hand, if the S&P 500 gained 5% and your portfolio gained 10%, well, you outperformed it. That's why benchmarks are useful. That's why benchmarks give something to investors to measure against. Here's another important distinction. You can't directly buy the S&P 500 itself. It's an index. It's not a company. But you can invest in funds designed to track its performance. These include S&P 500 index funds and ETFs. Instead of buying hundreds of individual stocks yourself, a fund can give you exposure to the companies in the index through a single investment. This is one reason S&P 500 funds are popular with long-term investors. Instead of trying to figure out which individual company will become the next big winner, an investor can own a broad collection of U.S. large-cap companies. Of course, that doesn't mean the investment is risk-free. The S&P 500 can fall, sometimes dramatically. During major market downturns, investors can see substantial declines in the value of their investments. But diversification across many companies can reduce the risk associated with owning just one individual stock. There's one concept beginners should really remember. The S&P 500 is not the entire U.S. stock market. It focuses primarily on large U.S. companies, very large companies. There are thousands of publicly traded companies, including smaller businesses that aren't represented in the index. So when someone says the S&P 500 represents the market, think of that as shorthand. It's an extremely important benchmark, but it isn't a perfect representation of every publicly traded company. So let's recap. The S&P 500 is an index that tracks approximately 500 large US companies. It's market cap weighted, meaning larger companies generally have more influence on its performance. It's widely used as a benchmark for the US stock market. And while you can't buy the index directly, you can invest in funds that seek to track it. If you're just getting started with investing, understanding the S&P 500 is one of the first concepts worth learning about. Because once you understand the S&P 500, you'll have a much better idea of what people mean when they talk about the market. Follow for more simple investing lessons. Next lesson, perhaps, what's an ETF?